The RBI's Monetary Policy Committee's April 5th to 7th meeting is happening in a context when India's growth is strong and the US economy, the Pied Piper of the world economy, is also growing strong. So, how should the Reserve Bank move on rates and on guidance? As always, CNBC-TV18 Citizens Monetary Policy Committee meets ahead of the RBI MPC to discuss the issues that will confront the RBI. I have with me the chairman of our committee, Dr. Pranab Sen, and members Samiran Chakrabarti, Soumyakanti Ghosh, Sajid Chenoy, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. Well, let me start with Sonal this time. Sonal, well, as I was just saying, the Indian growth seems to be strong. The US Federal Reserve has bumped up its growth forecast for 2024 from 1.4 to a whopping 2.1%. So, how should the Reserve Bank guide on growth? Will they also push up their forecasts?
Yeah, Latha, our view is it'll be a similar story in India as well. First off, actually, FY24 itself is ending on a strong note. So, vis-a-vis the 7.6% advanced estimate, the current estimates that most are talking about, including the RBI, seem to be closer to 8%. So, that sets us up on a strong base. For FY25, back in Feb, the RBI had projected a growth of 7%. Our sense is they will upgrade this number to potentially something around 7.2%, although in the latest bulletin, the models that they run actually have an even higher forecast of 7.4. But really, it does look like, yes, we will likely see an upward revision in India as well. And for the RBI in particular, I think they are seeing signs of private capex picking up. Global growth has been strong. Inflation in India is expected to come down, which should be positive for consumption. So on net, yes, more optimism on growth is what we expect. From our own perspective, though, our FY25 projections are closer to 6.5%. So on our side, we think the model code of conduct will mean some moderation in public capex in the first half of FY25. The private capex, we think, is not yet broad-based. And finally, I think on the consumer side, the various tightening of macroprudential norms that the RBI has announced, we think will lead to some moderation in credit growth in FY25.
Okay, Sonal, got that. Samiran, actually, let me toss the same growth question to you. Do you think growth is as strong as the Reserve Bank is making it out to be in the bulletin? And if it is, then should not the Reserve Bank sound hawkish?
So, Latha, two, three different ways to look at it. One is that there is this difference between growth as estimated through the GDP method versus the GVA method. As we know that there is, in this current point, a big divergence between the GDP and the GVA numbers. Our suspicion is that the RBI is going to talk more in terms of GDP rather than GVA. But we have to keep in mind the softness in GVA when we look at growth. The second issue is that this is also a growth which is somewhat two-paced because the investment growth is much stronger than the consumption growth. And in our analysis, we find that this could have a significant bearing on overall inflation. Historically, the output gap is not that much correlated with core inflation, but it is quite well correlated. Core inflation is quite well correlated with the consumption side of the economy. If consumption growth is what is driving the higher output gap, then there is a chance that core inflation can also pick up. But that's not the case this time around. So there is not much to be worried about the higher growth as of now. And the last point is that ultimately we have to also take a call on where India's potential growth stands. If because of all these supply side measures taken by the government, the potential growth itself has come up, then maybe the output gap is not as wide as it seems to be from the last 3 quarters GDP print. So because of these three reasons, I think RBI is likely to underplay the potential impact of higher growth onto inflation and can sound somewhat more comfortable that they've achieved both the things of high growth and low inflation on a more sustained basis.
Okay, then that should impact the stance, but I will come to that in just a bit. Let me first get all the issues on the table. Sajid, what should the Reserve Bank and the MPC take away from what the Fed has just said?
Yes, that I think, the first blush, the sense was the Fed was dovish because it had marked up its growth numbers, it had marked up its inflation forecast, and yet it had persevered with 3 rate cuts this year, though that was a narrow majority. So the first reaction, it was dovish and kind of markets reacted accordingly. But if you dig deeper, there are various cross currents that are worrying. First is the data is really not cooperating with the Fed. Right? There was the disinflation and core towards the end of 2023 that got everyone excited. But if you look at the last 3 months in the US, for example, the quarterly annualized momentum of core inflation is above 4%. And that's not going to keep the Fed comfortable. Now, this is no surprise because as we've discussed before, much of the core disinflation last year was because of goods. Goods were in deflation, a lot of it being exported by China, right? It was services inflation that was sticky. We're now in a situation where we've passed the trough of goods deflation. Goods prices are inching back up. Services remain sticky, and therefore core inflation is, uncomfortably high. So even though the Fed wants to ease, we may get a much shallower cycle from the Fed because if core inflation settles at 3%, which is above the 2% target. The second known unknown for the Fed is just the neutral rate. What is the medium-term rate? We saw the Fed move up the medium-term rate. And there's an increasing view here that long-run rates in the US may not be 2.5%, which is what everybody thought a year ago. They may well be closer to 4% because balance sheets are much stronger. Fiscal policy is more expansive post-pandemic. And all this would argue for a higher neutral rate. And if you look at it that way, it's no surprise that despite policy rates being at 5.5%, the US economy has not gone into recession. The US economy has not collapsed. In fact, it continues to be very resilient because if in fact neutral rates are 4%, reflecting healthier fundamentals, then in fact monetary policy is not as restrictive as was presumed through all of 2023. In other words, again, there's less space for the Fed to cut. So while the Fed did seem dovish, the data is not cooperating. We may get a much more shallower cycle. And I'll end by saying that the global environment is a little less benign than a few months ago. The US is growing very strongly. Europe is still expected to grow less than 0.5% this year. So if you get continued US exceptionalism, you will get a stronger dollar, which will weigh on emerging market currencies. And finally, we've seen crude back up in the high 80s, right? So the environment now is where emerging markets have to potentially brace for a shallow easing cycle by the Fed, a stronger dollar potentially, and crude in the high 80s or low 90s.
Okay. I think I'll have, if I have time, I'll come back to the neutral rate on India as well to you, Sajid. But first, inflation. Soumya, core is really undershot, 3.3%, and the Reserve Bank had once said that that's where they will really pay attention. And chances are we are going to have a La Nina this year after an El Nino last year. So do you think the Reserve can guide lower on inflation?
Yeah, thank you, Latha. I think on the inflation front, the story looks more comfortable, and of course the trajectory looks benign as per the trend is concerned throughout the next till the end of next fiscal. Most possibly the deflation in core, which has could continue a little while longer, and also the fact that if you actually look into the inflation trajectory of the RBI projections, I think the numbers could touch closer to 3% by July 2024. So, but the point to note over here is that there are, of course, statistical impact base effects are concerned. So if you take a longer period of time, inflation next year looks remarkably anchored in the range of 4 to 5%. So given this fact, and given the fact that the central bank has an inflation average of around 4.5%, which is not markedly different from the market forecast, I think that could give a lot of comfort to the central bank. But And possibly, but the most important point, I think, which Shamiran also pointed out, I think the relationship of the core inflation with the growth numbers. I think the deflation in core has actually surprised everyone. And if that continues, if the deflation in core continues, core is possibly supposed to get back into 4% after a couple of months. But even if it gets back to 4%, given the fact that we had a narrative of stickiness in core, I think that has surprised many. And possibly it will be important to understand whether the deflation in core will continue for a while, because that will give the RBI a lot of breathing space in terms of the overall reading of the inflation numbers.
Okay, well, let me toss this the inflation question to Dr. Sen as well. Dr. Sen, I'm, you're the former statistician, and we've just got this consumption, household consumption expenditure survey, which clearly indicates that the quantum of food that is there in the CPI needs to be brought down. Cereals need to be brought down, and those are the inflationary elements. So, if all this is going to come into the CPI and point towards a lower CPI, how should the Reserve Bank and the MPC look at the inflation picture?
As far as inflation is concerned, there are conflicting sort of effects of the new household consumption survey. So on one hand, food as a whole comes down. So that would reduce at least the volatility in the inflation numbers. But within the food group, what you find is that cereals, which is probably the most stable of the food items, has come down very significantly, and non-cereals, which is fruits and vegetables and so on, that has gone up significantly. So you've got two conflicting. Now, because of that, and because volatility is much higher in the non-cereal component, food component, you're really not out of the woods yet in terms of the food price-driven volatility in inflation. So I wouldn't be breathing a sigh of relief saying that, this whole food business is behind us. It isn't.
Okay. Well, I was hoping that one of you will say that they may guide inflation lower, but not just yet, maybe. The more important question is going to be liquidity. And especially after the inclusion of India in the bond index, which becomes effective June. That question after the break, and of course, what will the RBI do to stance? All that's coming up after the break. Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. I've been speaking with Chairman of our committee, Dr. Pranab Sen, and members Sajid Chinoy, Shaumya Ghosh, Samiran Chakrabarti, and Sonal Verma. Gentlemen and Sonal, thank you very much for your patience. Sonal, once again to you. Just before the break, we discussed that inflation has been benign, core at 3.3. Does the setup look like the Reserve Bank should tweak the stance?
Latha, there's a should and a would. Should the MPC change? The answer is yes, because a neutral stance, all said and done, implies the next move could be a hike, could be a cut, could be sustained pause. But I think in terms of would the MPC change, we don't think so, because the stance change is a signal, which they think is a signal that of a rate cut, and they would be wary of sending that signal too soon. And when we've actually looked at the last 3, 4, 5 years of stance change and actual rate move, that's indeed what we see. The MPC changes the stance belatedly after the actual rate move. So given the global uncertainty, we think they will not change the stance at this meeting as well.
Okay, got that. Won't change the stance. Let's see how everybody votes on it. But Samiran, now the all-important question of liquidity. What's your sense? There is also the bond inclusion, which will bring its own, impact on liquidity. Do you think the Reserve Bank is going to use more tools? What will they say?
So, Latha, a very interesting thing is happening on liquidity, which is that not only is the banking system liquidity pressure much lesser in the months of February and March. But even durable liquidity, which is the liquidity that RBI directly provides, that durable liquidity in the early part of March has gone up. This was continuously coming down, but durable liquidity has gone up. As a result of this, what we are witnessing is that the overnight rates, whether it's the weighted average call rate or the TREPS rate or the CROMS rate, market repo rate, everything is now coming closer to the repo rate rather than staying closer to the MSF rate. And the RBI does not seem to be fighting against it. So for context, for almost 5 months, these rates were all closer to MSF than closer to repo. The fact that RBI is allowing it to settle closer to 6.5 is an indication that the first stage of monetary policy easing might already be in place, or at least RBI is comfortable on certain aspects, whether it is core inflation, whether it is coming from global or it is coming from financial conditions, from the financial stability angle. RBI is comfortable that it can run the system now on the BAU mode of taking it closer to repo rather than keeping it closer to MSF. Now, what happens from here on, we have to see, because as you mentioned, if the bond index inclusion flows come, if BOP surplus remains exceptionally strong, then RBI at some point of time will have to consider taking off some of this liquidity through more permanent measures, more durable measures as well, like OMO sales. Our calculations seem to suggest that in the first quarter of FY25, OMO sales might not be required, but as we move in the latter part of the year, it seems that that's a possibility that RBI will have to consider. That should not worry the markets much as long as liquidity is ample enough to keep overnight rates anchored towards repo rate rather than getting them anchored at MSF rate.
Okay, oh, sales. Well, there is also currency in circulation that may increase, we thought, but it's not increasing. Point taken, Samiran. Shaumya, anything you want to add on liquidity, rupee that the MPC should be concerned about? But the more important question I have for you is, any more macroprudential steps that the RBI might announce? You are with the biggest bank. So tell us, unsecured loans already the Reserve Bank is chasing. Anything else?
No, Latha, I think today, just for the sake, today the credit data came till the month of February. It's exceptionally strong at 25.3 trillion. And the important part is that the sectors which are growing are other than the unsecured one. The agriculture and the MSME sector growth is 26% of the overall expansion. So it's almost a broad-based. Now, having said that, regarding the liquidity and the exchange rate, I think the improvement in liquidity in the month of March was more because of the government has started to spend, because if you remember at some point of time, the government outstanding cash balances were around 5 trillion. It has now moved down to 2 trillion. And as you know that we are actually moving on to a new system of this management of government cash balances, which will remain outside the banking system and with the RBI. So that will mean that in the future, if the government goes ahead with the move of this just in time, it will continue to make the government cash balances the elephant in the room, and the entire liquidity will be driven by that factor. So that means that the VRRR injections with the RBI has been doing will have to do. But the interesting trend to note in the next fiscal year is basically the capital flows because of the bond inclusion indices, possibly a larger capital flows because of the bond inclusion indices could take away some of the inherent idiosyncrasies with these government cash balances. And maybe if the liquidity get into too much of a surplus mode, the RBI can think of liquidity measures in between. But my sense is that as of today, the FY25 will open up challenges and opportunities for the Reserve Bank in terms of liquidity management. And at some point of time, that will become more crucial rather than the inflation control, which seems to be better off at this point of time.
Point taken. Actually, it has been that way, isn't it? Liquidity has concerned them more. than macros like inflation. Okay, Sajid, let me come back to the neutral rate question. Jayant Verma actually raised it when he spoke to me after the minutes were announced, that actually the difference between the real growth rate, the inflation rate and the actual interest rates is 200 basis points. This is restrictive, he argues. Now, who is to say that Ashima Goyal also won't argue like that? How do you think we should think about this real rate?
Like I alluded to in the case of the US, Latha, there are just so many moving parts that it's not possible to have strong convictions in what the neutral rate is. So just to make this easier for viewers, when central banks think about setting policy, and any kind of typical Taylor rule would say you need to have some kind of anchor. What is your neutral rate, neutral real rate? What is the rate at which the growth is at potential and inflation is at target? And then you adjust that for whether inflation is above target in the cycle and whether there's an output gap. Now, what that real neutral rate is subject to a lot of uncertainty. There's a presumption in India that the real neutral rate was about 1.5% pre-pandemic, that it's come down to 1% now, and therefore looking forward 200 basis points is very tight. But remember what that real neutral rate depends on. It really depends on the propensity to invest and save. And think of what's happened in the last 3-4 years. We were beleaguered with this twin balance sheet problem for almost a decade. And therefore, there was very little proclivity to invest or to lend. And that should have pushed the real neutral rate down. But all that has changed in the last 3 years. We're now seeing the healthiest bank balance sheets in a decade, where there's a much greater proclivity to lend. We're seeing corporate debt to GDP has come down with the prospect that investment might pick up. All of that would argue for a higher neutral rate. As I mentioned in the case of the US, even though the center's fiscal deficit is coming down, if you look at the public sector more generally, center, states, PSU, we're still much higher than where we were pre-pandemic. By itself, that would argue for a higher neutral rate. Now, to the extent that we are below the pre-pandemic path, that would argue for a lower neutral rate. In other words, there are too many known unknowns. Some work that the RBI itself has done has suggested that one model in 2022 showed that the real neutral rate was, between 80 to 100 basis points. But if you just simply overlay that model with the financial cycle, the real neutral rate goes up to 200 basis points. In other words, it's not possible to have strong preconceived notions about what the real neutral rate is. I'll end by saying the fact that credit growth is running at 15-16% at a time that nominal GDP is at 9% is hardly suggestive that monetary conditions are excessively tight. So I think this will have to be another year where the proof of the pudding is in the eating, and the RBI will have to, cross the river by feeding the stones.
Well, you're almost sounding hawkish to me, but I thought Soumya sounded dovish. But Dr. Sen, that's the overall question to you. Chairman, sir, should the Reserve Bank's overall message be hawkish or dovish?
Now we have to keep in mind, in all this discussion, we haven't really talked about the forthcoming elections. And elections always introduce a very large dose of uncertainty into economic policy making. And in a situation of that kind, the RBI will have to be more cautious than they would have otherwise. So, if you listen to what, very carefully, in fact, to what Sajid was saying, that is under normal circumstances. Risk weights now will have to be increased at least for the next couple of quarters quite significantly. So I would imagine that RBI will have to keep as much of their ammunition intact as they can and not take any precipitous steps at the moment. They'll need to just play it by the ear for at least the next couple of quarters.
Well, point taken, Dr. Sen. That's the voice of experience speaking. Yes, the political backdrop is very important. But we are out of time, so let's start the vote. The first question, obviously, what will the Reserve Bank do to interest rates? Well, let me start with you, Sonal. What's your vote?
Pause.
Pause. Okay, Samiran, your vote?
Yeah, pause on rates.
Okay. Soumya, your vote?
Pause.
Okay. Sajid?
Pause.
Dr. Sen, well, it's a pause all over. Your vote, Chairman?
Pause. We are all on the same
That's
page.
unanimous. That's unanimous. Let's see if there's any change in stance. Sonal?
Retain the stance.
Okay. Shamiran?
No change in stance for now.
Okay. Shaumya?
No change in stance.
Okay. Sajid?
No change in stance.
Okay. Well, Dr. Sen, you think it's time to change the stance?
I would move to neutral. We do not know what's happening.
All right. Okay. Well, let me ask the more relevant question, perhaps. When do you guys expect the first rate cut? Sonal?
We expect August onwards.
Okay. Samiran?
We think it's starting October.
All right. Shaumya?
October.
Okay. Third quarter would be again October, December. Okay. Sajid?
Between August and October.
Okay. Well, Dr. Sen, what's your vote, sir?
After August.
Okay. Okay, then it looks like at least for the current and the next policy, we don't see too much of a change. Status quo is, but plenty on liquidity that we will hear out from the Reserve Bank, especially with the bond inclusion. Thank you very much, members of the Citizens Monetary Policy Committee, for your deliberation.